Welcome to Mortgage Power Hour. I'm with Brielle, our lovely business development manager here at Loans Incorporated. We're going to go ahead and go through a list of some highly questioned mortgage questions. People don't learn this stuff in school, so we're going to go ahead and go through a bunch of questions. And if you have any questions outside of these, feel free to reach out to us. We're happy to help answer anytime. Brielle, without further ado, are you ready to get started on the Power Hour?
All right.
All right.
Question 1. What is a conventional loan in plain English?
So many people misrepresent what a conventional loan is. In plain English, it is a loan secured by private funds.
Testing your knowledge. How much down payment do you actually need for a conventional loan?
So a conventional loan for a first-time homebuyer starts at 3% down, which is actually lower than an FHA loan. If you're buying a home as not a first-time homebuyer with a conventional loan, then it's 5% down for a primary residence.
What credit score gets someone the best conventional rate?
780 and above. Some people say 760, some people say 750, but the truth lies at 780. That is going to put you in the highest, best interest rate tier for a mortgage.
When does mortgage insurance fall off on a conventional loan?
Once the loan reaches 78% LTV, it will automatically fall off the loan. If you're putting down a 5% down payment, this is typically after about 11 years. Now, once you hit 80%, which is 20% equity in the home, you can manually reach out to your mortgage servicer to have this PMI removed off your mortgage.
How does someone get rid of PMI faster?
So if I were to get rid of PMI faster, I'd first look at how much your home is worth. Do you have 20% equity in your home? If you feel like you do, then you can call your mortgage servicer out of get an appraisal done. And if your home is worth more than the 80% LTV in the house, then you can get the PMI removed.
What's the biggest mistake people make when applying for a conventional loan?
The biggest mistake people make when they're applying for a conventional loan is thinking they need to put 20% down, or thinking that if they put less than 20% down, PMI is going to be a large part of their payment. If you have good credit and you're putting down 5, 10, 15%, your private mortgage insurance is only going to be anywhere between $20 to $50, maybe $100 at the absolute most extra a month. So it's really not a substantial part of your monthly mortgage payment.
You should not use a conventional loan.
Veterans, if you have entitlement for a VA loan, you should absolutely take advantage of that.
Do you need 20% down to buy a home?
No, that is one of the biggest misconceptions with buying homes is you need 20% down for a down payment. So if you're a first-time home buyer, you can buy a home with 3% down on a conventional loan. FHA loans, you don't have to be a first-time home buyer. You can buy a home with 3.5% down.
How does debt-to-income ratio affect a conventional approval?
So for a conventional loan, you need to be under a 50% debt-to-income ratio. So the way we calculate this is we take all the debts that are on your credit plus the new housing expense. So if your new mortgage payment's $2,000 a month, all your debts combined, your car payment, credit cards, all come out to, let's just say, $1,000 a month. We take your debt to income ratio over $3,000 a month over your income. So if you make $5,000 a month and you have $3,000 a month in debt, you're going to be over the 50% debt threshold. So if you're making $6,000 a month and you have $3,000 a month in debt, that's going to bring you at 50% debt to income ratio. So you really want to be under that number.
We're getting into FHA.
All right, let's get into it.
All right. Who is an FHA loan really meant for?
So an FHA loan is really meant for folks who may have less than perfect credit or that they're looking to buy a home with less money out of pocket. The interest rates are typically lower. However, there is a upfront mortgage insurance that is financed into the loan plus a monthly mortgage insurance, which is called MIP, which is different than PMI. PMI comes off the loan, but for an FHA loan, it's on for the life of the loan unless you put more than 10% down.
And how low can your credit score be for FHA?
So your credit score for an FHA loan can be as low as a 500. However, if you're between a 500 and a 580, you'll have to put down 10%. 580 and above, you can go with a 3.5% down payment.
How much down payment does FHA require?
3.5% down. You can't put any less than 3.5% down on an FHA loan.
And why is FHA mortgage insurance permanent now?
If you put less than 10% down on the home, then the mortgage insurance premium is on the life of the loan. However, if you do put more than 10% down, it does come off automatically after 11 years.
When is FHA better than conventional?
Your debt to income ratio is above a 50%, or your FICO score is below a 620, FHA loan is going to be your best bet. That's pretty much it.
What are the biggest myths about FHA loans?
The biggest myth about an FHA loan is you need to have a low credit score to use one. And that's just simply not the case.
Do sellers hate accepting FHA offers and why?
So I'm a loan officer. This might be a better question for a real estate agent. However, there's so many misconceptions about an FHA loan offer. In fact, as long as the home is habitable, there's no hazards in the home, safety hazards, missing railings, peeling paint, there should be no difference on an FHA offer versus a conventional offer.
Can you use gift funds on an FHA loan?
You can absolutely use gift funds on an FHA loan.
And does FHA allow cosigners?
FHA loans do allow cosigners. And the cosigner does not have to be a first-time home buyer, nor do they have to have perfect credit as well.
And last FHA question. Can you buy a duplex or triplex with an FHA loan?
The answer is yes. You can buy a duplex, triplex, or a quadplex, a 4-unit property with an FHA loan. However, keep in mind, anything 3 units or above, you're going to have an FHA self-sufficiency test, which pretty much means when they look at the appraisal, the rents that would come in for those other units have to equate to the mortgage payment minus 25%. Otherwise, it will not pass the self-sufficiency test, and FHA loan will not fund.
VA USDA questions.
Okay.
What makes VA loans so good?
Well, one, if you're a veteran, you can finance 100% of the down payment, also the VA funding fee. And this funding fee can be partially waived depending on your disability. So it's an amazing program for veterans who want to get into a home with very little out-of-pocket cost.
Do you need a down payment on a VA loan?
You do not need a down payment on a VA loan. However, there are still closing costs, and these cannot be financed into the loan besides the VA funding fee.
Why do sellers sometimes avoid VA buyers?
The biggest reason I would say is due to the appraisal. VA appraisers are hired by the VA, and they are looking for health and safety hazards in the home. Some sellers might be wary of this because they're afraid that the home might not appraise, or there might be issues that come due to the appraisal. But if it's a perfectly good habitable home with no outlying issues, then there should be no difference on a VA offer or conventional offer.
What is the VA funding fee and who pays it?
So the VA charges a funding fee to the veteran for the VA loan. So this can be financed into the loan. Also, this funding fee can be waived depending on the disability status of the veteran, but the veteran is responsible for this VA funding fee.
What is a USDA loan and who qualifies?
A USDA loan is for people who live in a rural area. So if you live in a rural area, you can qualify for a USDA loan. There's a lot of benefits with this, like 100% financing for a USDA loan. Actually, every county in Pennsylvania qualifies for a USDA loan. There's areas besides Philadelphia County.
Do USDA loans really require 0% down?
Well, they don't require 0% down, but you can put 0% down.
And what counts as a rural area for USDA loans?
In order for you to qualify for a USDA loan, you have to look at the population density of that area. Depending on the county that you're in, you can find this online on the USDA's website.
And are VA or USDA appraisals harder to pass?
Short answer is yes. These are appraisers that are hired by the government. So the way that they look at these homes may be different than a private licensed appraiser. However, I would say if there's no safety or any hazardous issues with the property, then these are of less concern.
All right. That was it for VA and USDA. DSCR loan. What is a DSCR loan in simple terms?
If you have a home, this home rents for $1 a month, and your monthly mortgage payment is $1 a month, then you have a 1 ratio for a DSCR loan. So pretty much you want to equate your monthly rent to your monthly payment. The more rent you get for the home than your payment, the higher DSCR ratio is, the better terms you get. The less, the worse terms you get.
Awesome. How does a DSCR lender decide how much you can borrow?
It's really determined based off of how much money you can put down and also how much rent the property can bring, because a DSCR loan does not look at your personal income to qualify you. It looks at the property. So if the property only brings in $1,000 a month in rent, but your mortgage payment's $3,000 a month, that doesn't make sense. And if you are trying to buy a $500,000 property, but you only have $5,000 to put down, you're not going to be able to buy this house with a DSCR loan because they require at least 20% down to buy.
What DSCR ratio do most lenders want to see?
So most lenders want to see a 1.0 ratio at least. So this means your monthly mortgage payment, and this includes your principal, interest, taxes, insurance, equate to the monthly rents the property will receive. And this is determined by the appraiser. So they want to make sure that if your monthly payment's $1,000 and your rent's $1,000, that these line up. However, there are certain lenders that do lend to you on a DSCR loan without having a perfect 1.0 ratio. It can be actually less, like a 0.8 ratio or a 0.7 ratio. This just impacts your terms of credit, like your interest rate or your LTV requirement. However, if you look in the opposite direction, where your ratio is actually higher, like a 1.5 ratio or a 1.25%, this will actually get you better terms, like a better interest rate on the mortgage.
Do DSCR loans require tax returns?
No, DSCR loans do not require tax returns. We don't look at your tax returns at all with the DSCR loan. All we care about is the property. We look at the property to qualify you. So we look at the property's appraisal, the value. We look at how much the property brings in rent. That's how we qualify you on a DSCR loan.
How much down payment do investors usually need?
So on a DSCR loan, you'll need 20% down at least to put down.
And what's the downside of using DSCR loans?
The downside is the terms are typically higher than a regular conventional and Fannie Freddie loan, but not by a significant margin. I mean, you're talking about potentially 1/4 of a point, 1/8 of a point, depending on if you want prepayment penalty or not. So really you're looking at a very similar interest rate than a regular conventional loan. However, they do come in slightly higher.
Are DS rates higher than conventional investment loans?
Yes, they are, but not by a significant margin, especially when you're using a mortgage broker who specializes in these loans like myself here. So if you're ever curious to see what a DSCR rate looks like compared to a conventional loan, we can run that pricing all day long. Just check us out, loansincorporated.com.
Who should use DSCR loan instead of a normal mortgage?
If you are someone who wants to invest and scale your portfolio for investment properties, a DSCR loan is built for you. We're not looking at your tax returns. We're not looking at your pay stubs. You can close in your LLC. This is huge. We can also guarantee that this loan does not show on your credit report and is only under your business. So they're great loans for someone like that.
Can you use DSCR for short-term rentals or Airbnb?
You can absolutely get a DSCR loan that is specific for a short-term rental, like an Airbnb. You're just going to have to get a special form on your appraisal for short-term rentals.
And how fast can DSCR loans typically close?
So we can close a DSCR loan depending on the appraisal in about 14 to 21 days. If we do a rush appraisal and we get it done and back in a few days, we can close these things out in less than 2 weeks.
All right, on to non-QM, self-employed. What is a non-QM loan and who is it meant for?
These loans are for out-of-the-box type loan scenarios where they're not following that big guideline book set forth by Fannie Mae or Freddie Mac.
And how does a bank statement loan work?
A bank statement loan works exactly how it sounds. There's two options. There's a 12-month bank statement loan where we look at the last 12 months of your statements, or a 24-month option where we look at the last 2 years. That gives a slightly better terms because we're looking at more history, but we can look at your personal bank statements or we can look at your business bank statements.
Can someone buy a house with only 1099 income?
Absolutely. So there's a specific loan called a 1099 qualifying loan, where if you're buying a primary residence, you can put 10% down. And we look at your 1099s. This program's amazing for real estate agents where all they have are 1099s or a newer realtor. They haven't filed their taxes yet. Perfect scenario for you.
How much down payment do non-QM loans usually require?
So most non-QM loans for a primary purchase are going to require at least 10% down. Investment properties, they're going to start at 20% down.
Are non-QM interest rates way higher?
No, actually, believe it or not, non-QM interest rates are not way higher. Are they higher? Yes. Are they higher by significant margin? No. You can still buy a home with a non-QM loan on a primary purchase with good credit and still get a decent market rate.
What's the biggest myth about self-employed buyers?
The biggest myth about self-employed buyers is you need to show a substantial amount of income on your tax returns. Well, if you have a lot of write-offs and a lot of business-related expenses that your accountant or CPA writes off on your taxes, that you have to show more income on your tax returns. But that's just not true. Now with bank statement loans, profit and loss statement loans, we can qualify you on a mortgage not based off your tax returns, which is a huge benefit to business owners who are not sure about how much income shows on their tax returns.
All right, that was it for non-QM.
Okay.
We got rate and refinance. How do interest rates usually get determined?
Interest rates get really determined by the lender. It's based off of the 10-year treasury bond, and the lender sets the rate. Lenders who want more of a specific type of loan will give lower rates for that specific type of loan. Let's just say it's a FHA loan or a conventional loan that has 10% down. They want more of those loans. They're going to offer lower rates. So the lender sets the interest rate.
And what's a good reason to refinance today?
A good reason to refinance today is the equity that people have in their homes are at an all-time high, but consumer debt is also at an all-time high. So if you're paying 28% on a credit card and you have $200,000 of equity in your home, even if you're paying 3 or 4% on your primary residence current rate, if you were to take out a new loan at 6% today, and pay off all of your debt, your car debt, your credit card debt, any outstanding debt that's at a high interest rate, and it's a no-brainer to take out that equity of your home and refinance your loan.
When should someone not refinance?
Someone should not refinance who genuinely does not need the funds to take out of their home and can borrow money at a lower rate. Like if you have a 3% interest rate on your home, don't refinance unless you need those funds to pay off debt, or if you're looking to invest those funds further into real estate or any other asset. People make the mistake of over leveraging. And if you're paying a very low interest rate on your home and you don't need any funds for anything specific, don't refinance.
What is a cash out refinance and when does it make sense?
So cash out refinance is a loan where we take the equity that you've built in your home and you take out a percentage out of your home. So typically up to 75% of your home's value you can take off. You'll have to pay off your old mortgage. So if your home's worth $500,000, you owe $200,000, you have to do $200,000 and then plus the equity in between. That gets you to 75%. This is really for people who are maybe looking to pay down debt. They're looking to create a fund for their kids' college. They're looking to do different things with the money and they need the liquid cash and they just don't have it. So that's really who these loans are for.
Do people wait for rates to drop or buy now?
So if you are ready, willing, and able, and emotionally are ready to buy a home, there's no reason to wait. If you have an actual need to buy a home, you really can't worry about the rates. You got to just go ahead and do it. A 6% or a 3%, people still need housing and they need homes. So the short answer is no, don't wait. Just go ahead and buy that house, but don't rush into it. If you're not really ready to go and do it and you just want to buy a house because your friend from college bought one and you want to keep up with them, then it doesn't make sense. But if you're really ready to do it, then go for it.
All right, question 50. Last one. What's the number one thing buyers should do to get the lowest rate?
The number one thing that buyers should do to get the lowest rate is work with a mortgage broker. I'm a mortgage broker. I've worked with a correspondent lender, retail lender. I've worked in pretty much every part of a mortgage, and mortgage brokers offer the lowest rates by far out of all the different types of mortgage companies. The only time where that might not be true is if there's a credit union that has a special type of mortgage, like a ARM or special portfolio product, or if you're maybe a high net worth individual and you're working with like Chase or a bigger bank that has a certain discount. But if you're a normal, everyday, working American, reach out to a mortgage broker.
If I make $85,000 a year, what price range can I afford with today's rates?
Great question. So it really depends on the area that you live in. So if you make $85,000 a year, that equates to $7,083 per month. For a conventional loan, you need to be at a 50% debt to income ratio or lower. So Anything around 33,000 to 3,250 a month is going to be your absolute max. However, if you have debt like car loans, you have credit cards, student loans, and that is also added to your debt to income ratio. So let's just say that equates to 1,000 a month. Your mortgage payment really can't exceed 2,000 to really 2,250 a month. So at this price range, to say you're assuming no debt and just the mortgage, let's just say 2,800 a month, you're probably really looking in the mid 300,000s range safely to buy a house.
We make 150,000 combined. How big of a house can we safely afford?
150,000, that is a great substantial income. So $150,000 a year is $12,500 a month. So with this type of income, depending on your current debt, you can afford a substantial house. We really look at debt to income ratios. We want to stay at 50% or under. So for someone in your situation, you can really look at a $500,000-$600,000 home with ease and probably a little higher. It just depends on your current debt. So make sure you add up all the debts that show on your credit report, your monthly payment. And then when you're looking at a new housing payment, look at what that payment is. Really reach out to a loan officer or a mortgage broker like myself, and we can help guide you on what you can afford and how much you can go up to.
I only have 12,000 saved. What kind of loan can I get?
If you only have $12,000 saved and you're looking to buy a house, I would recommend an FHA loan because FHA loan, they can actually allow you to get up to 6% seller's assist with a 3.5% down payment. And if you only have $12,000, you're going to need some help. You're going to need either grant funds or seller's assist. Conventional loan is also a great option as well, but you can only get 3% seller's assist. But you can put 3% down on a home. So if you're looking to offer maybe a little more for that house and get some money back in credits from the seller, I think a FHA loan is probably the best bet for someone in your situation.
I have a 580 credit score but stable income. Can I still buy?
Absolutely. If you have a 580 credit score, this is a perfect credit score for an FHA loan. 580 and over allows you to put 3.5% down on a home. And with stable income, this is a perfect loan for you.
I have a 760 credit score but no savings. What are my options?
Your options are very limited unless you are a veteran. So if you're a veteran and if you have no funds to put down, you can finance 100% of the loan. However, you still have closing costs, but you can get these closing costs covered by the seller in the form of seller's assist, or you can get a gift to cover these funds if you're so lucky to have someone who will help you out.
I want to put down 3%. What's the catch?
You're going to need to have a conventional loan. At 3%, you're going to have a higher rate for PMI, but that's essentially it. I mean, the rates are still very good at 3% with a great credit score. It just comes down to you're going to pay a little more in PMI and your payment's going to be higher.
If my credit score jumps from 680 to 740, how much does my rate change?
That's a great question. So if you go from a 680 to 740, you're probably going to see your rate at least change by about 1/4 to 0.5%, maybe even more depending on the loan product like conventional loan.
I want to buy a house with gift money. What do I need to show the lender?
You're going to need two things. You're going to need a gift letter, and you're also going to need a proof of receipt of those funds. If they send that money directly to you, we need to show a statement or activity statement showing those funds go in your account. The cleanest and easiest way to get a gift is get the gift letter and have the donor send those funds directly to the title company. Wire is the best way to do it, and we just show a copy of the wire receipt from the title company.
If I have a 640 score, should I do FHA or conventional?
I would recommend a FHA loan at a 640, even though the minimum for a conventional loan is 620. Really at a 640, unless you're putting more money down than like 3 to 5%, maybe like 10%, you're going to have a hard time getting the computer to give us an approve. So the computer has to say yes or no to your loan. And this is called DU or LP. And at 640, it's going to be hard to get an approve with a low down payment option. So conventional, if you have a higher down payment, FHA if you're looking for a lower down payment.
We want to buy a duplex with 3.5% down. Is FHA the only option?
Yes. So they actually just changed this rule for conventional where you can put 5% down 2 years ago. However, if you're looking to only put 3.5% down on a duplex, FHA is the best option for you.
If I do FHA now, can I switch to conventional later to remove PMI?
You can. So if you buy a home today with an FHA loan, You can later refinance to a conventional loan as long as you qualify for one, and you can get that MIP removed. MIP is FHA's mortgage insurance premium. You can get that removed. You just have to have enough equity in your home to have it removed. Otherwise, you have to bring money to the refinance to get rid of that PMI.
I'm a veteran. Is there any reason not to go VA?
The short answer, from my opinion, is no. One, VA, you're going to have no private mortgage insurance or no mortgage insurance premium. You can finance up to 100% of the down payment. The only con really is the VA funding fee, but if you're getting, disability, this can be waived or partially waived. So if you're a veteran, I would go with a VA loan. That's your best option for anyone.
Is it true conventional is better if I have 20% down?
Yes, conventional is better if you have 20% down because FHA loan, you're still going to have mortgage insurance, and it does fall off after 11 years automatically, but you still have it. So if you have 20% down and you have a credit score that's high enough for a conventional loan, you're going to go conventional.
Investor and DSCR and LLC.
Yeah.
I want to buy a rental property using an LLC. How do I finance it?
You can finance it in a few different ways. The best and easiest way is going to be a DSCR loan. This is where we look at the property's income, not your personal income. If you wanted to buy a home in an LLC for an investment property, you can do what's called full doc. So we can look at your pay stubs if you work a W-2 job, and we can qualify you based off the tax returns if you own other properties. However, if you have issues due to expenses on your tax returns or issues with your current employment, I would highly recommend a DSCR loan. This is going to be your cleanest and quickest option to buy an investment property in an LLC.
If the property cash flows $300 a month, will DSCR lenders approve it?
They should. Yeah, absolutely. As long as the appraisal looks good and if it's cash flowing $300 a month more than the mortgage payment, absolutely. Yeah, this loan would be approved.
I want to buy an Airbnb. Can DSCR loans be used for short-term rentals?
Yeah, so if you're going to get a DSCR loan for a short-term rental, when you order the appraisal, you're going to get a standard 1004 to show us the value of the home. But you're also going to get a 1007, which is a rent schedule form, but you're going to get it specifically for the short-term rental option. And your loan officer or mortgage broker is going to order this on your behalf. Just make sure they order the right form because a lot of loan officers who don't work with a lot of DSCR loans could make this mistake. So make sure you reach out to someone experienced with this.
I have 5 rental properties already. Do lenders get stricter after a certain number?
If you're looking for a DSCR loan, this actually is more beneficial to you because it makes you a stronger buyer and you're experienced. If you're buying a home with an investment home with a conventional loan, well, all 5 of these properties, are you filing them on taxes? How much is being written off? Are they showing positive or negative cash flow? So if you're someone who has 5 properties and you want to be seen in a positive light, I would maybe consider a DSCR loan over a conventional loan.
The property doesn't cash flow at current rents. Can I still get an investor loan?
Yeah, so if the property is below a 1% or a 1.0 DSCR ratio, you can still get a DSCR loan. However, you're going to pay higher terms. So you're going to have a higher LTV requirement, and you're also going to have a higher interest rate than a positive cash flowing property.
I want to BRRRR a property. How can I refinance?
The property has to be in a habitable condition. So make sure the property is ready to go and is move-in ready. Once the property is move-in ready, give me a call and we'll get you refinanced.
What does BRRRR mean?
It's buy, rehab, refinance, repeat.
If I buy a duplex as a primary resident, can I move out after a year?
Absolutely. Yeah. Once you live in the property for a year, that's the 12-month residency requirement. So when you buy a home as a primary residence, you have a 12-month occupancy requirement. Once the 12 months is over, you can move out of the house and rent it out the next day.
Can I use projected Airbnb income for financing on a DSCR loan?
Absolutely. You just need the short-term rental form in your appraisal, and you can absolutely finance a home DSCR loan with the purpose of an Airbnb.
Now, self-employed, non-QM scenarios.
Okay.
I make great money but write everything off. Is a bank statement loan my only option?
Bank statement loan is not your only option, even though it's a great option for you, but you also have other options like a profit and loss statement loan. So we can get a profit and loss statement loan signed off by your CPA, and we can get you qualified based off of this. You can still buy it at 10% down, same with a bank statement loan. Interest rates might be slightly higher on the P&L loan, but they're both great options for someone who's self-employed but writes a lot off on their taxes.
I just switched from W-2 to 1099. Can I buy a home right away?
Great question. So the short answer is yes, you can. We need a history receiving 1099 income. It depends on what line of work you're in. Were you in the same line of work beforehand? If you went from a commission-only W-2 to now you're going 1099, doing the same thing, maybe like sales of some sort. The short answer is yes. It's just you're going to have a higher down payment requirement than if you were to be, a regular W-2 employee with history of that.
I'm a business owner and pay myself low W-2. How do lenders calculate my income?
We actually look at your W-2 if you're self-employed on a conventional loan as part of the whole story. We look at specific line items in your tax return and we give that back to you in income, for example, like depreciation. There's also other line items that we use. But W-2, yes, we count that to give back to you, but it's not the only item we look at. If you have any questions on whether or not you would qualify for a conventional loan, I would let your mortgage broker review your tax return before you go home shopping.
Can I qualify using only my business revenue?
Yes, you can. So you can do what's called a business bank statement loan. So we would look at either the last 12 months or 24 months of bank statements, depending on which program you go with. And we look at your business revenue. We also have to look at what's called a business narrative form. So it kind of gives us an idea of what kind of business you're running and give you a percentage back in usable income for a loan.
Right. Refinance and equity. I bought a 7% and rates dropped to 5.5. When should I refinance?
Now, that's substantial. I usually recommend if the rates drop, around a point to point and a half, it might be considered to start looking. But a point and a half, and if the rates keep going down, I would start looking at your options now and see how much money you can save each month.
I want to refinance and take out $50,000 for renovations. How does that work?
Yeah, so you would get what's called a cash out refinance. So we would look at your current equity position in your home, and then we'd give you a quote on what your new mortgage payment would be based off of the current interest rates and the extra $50,000 you're taking out. And usually, if you're looking to do that, it's a lot cheaper than taking out, a personal loan or putting on a credit cards.
My payment is too high. Can I get a lower payment without refinancing?
You can. However, it's going to require a lot of cash. You can do a principal reduction. You call your mortgage servicer. You'd say, maybe I want to put $100,000 down on my principal. What they do is they recast your loan and give you a lower mortgage payment each month. However, to do that without refinancing, you're going to have a lot of capital.
I have a 3% interest rate but need cash. Should I refinance or get a HELOC?
I would recommend looking at a HELOC option first so you don't lose on that 3% rate. Even though the payment's going to be slightly higher, you're going to be able to pay off that HELOC that has a much higher rate and retain that first lien on that home with the 3% interest rate, which honestly is probably a once-in-a-lifetime interest rate.
Should I ever refinance just to remove PMI?
No, I wouldn't refinance to remove PMI if you have a conventional loan, because this PMI is going to fall off. If you already have a below market interest rate, I would not. Now, if you have a higher interest rate and you want to get rid of the PMI and you have enough equity now in the home, then that's a different story. But if you have a 3% interest rate and you're paying PMI, call your mortgage servicer and see about getting your PMI removed anyway, because you probably have enough equity in your home at this point to get this removed. So no, the short answer, no.
First time buyer. I'm renting for $2,200 a month. What's the equivalent mortgage price?
So $2,200 a month is going to bring you around the $300,000 home category with around 5 to 10% down payment, maybe slightly more with 10% down, but probably somewhere in the 250 to 300 is pretty safe with a lower down payment.
I want to buy my first home with zero down. Is that possible?
It is possible. There's 3 options. Option 1 is a VA loan, but you have to be a veteran. Option 2 is you have to use a USDA loan, but you have to be in a rural area. But option 3 is a program that not many people talk about. It's called the FHA 100% program. So what you do is on an FHA loan, you have a minimum of 3.5% down. But what you do is you have your typical 3.5% down payment, but you take out a second lien or subordinate lien to cover that 3.5% down. You essentially finance 100% of the down payment. Now you still have closing costs, but what's amazing is on the subsequent lien, you can actually take out an extra 1% or so to help cover some of the closing costs. So you still have some closing costs, but you cover 100% of your down payment plus a little bit of your closing costs.
I don't have a long credit history. Can I still get approved?
You can still get approved. You just need to do what's called a manual underwrite. So manual underwrite looks at non-traditional lines of credit, like do you pay your phone bill on time? Do you pay your other utility bills on time? It's pretty much the same. Interest rate is slightly higher, but if you don't have credit or use much of credit, this is a great option for you.
I want to buy a house, but I don't know where to start. What's step one?
Step one is contacting a mortgage broker. So a mortgage broker is the best resource for you as a first-time home buyer. They can guide you with the correct paths of where to go, how much you can afford, how much you can be pre-approved for, what your monthly payments looking like, how much money you're going to need down, and just give you the best overall outlook of buying a home. We actually got through Mortgage Power Hour in less than an hour, Brielle.
If I want to buy a house with my LLC, will it show on my credit report?
If you want to buy a house with your LLC and you're worried about it showing your credit report, you have to specifically ask the mortgage loan officer you're working with because most lenders will not guarantee that. However, myself as a mortgage broker, I can guarantee that because I work with so many different investors and I know which ones will guarantee that. So wholesale lenders, some will. So the short answer is yes. You just have to make sure you speak with the right mortgage broker. If you're concerned about closing a home on your LLC and don't want it to show on your credit, give me a call because I can make that happen for you. If you are in the market for a mortgage or need a really great loan officer to refer your clients to, feel free to give me a call or text anytime. My name is Alex Pagano, mortgage broker, and stay tuned.